people tend to make that huge mistake of going into the asset that's done the best looking backward. If you look at the situation today, the US is priced for perfection.
Why are retail investors underperforming the markets by a huge margin? Well, first of all, unfortunately, it's still the case that they like to buy high and sell low. And then additionally, also they point the fingers at those who are holding a stock which is going into the red. And so I think this is especially the case again right now in Chinese equities. I think this is a broader theme and a picture that aligns well with my experience of investing in stocks that are almost bankrupt, like NIO, that have lots of fear, uncertainty and doubt around it, like Tesla, or in assets like Bitcoin, which are highly controversial. And I'm feeling right now it's the same case with Chinese equities. And most of the times, if the FUD is actually not sustained or fundamental, then this is the best time to invest, in my point of view. Of course, it's the hardest time, and who can blame those retail investors that are selling off Chinese equities when most of the media out there is, of course, bashing China, using images that are projecting China to be a certain way, like Maoist, communist, all of this war rhetorics around it and so on. But I really like to stress kind of a more realistic view on what is actually happening. And so this is again about giving you some different voices here. What is interesting with Chinese equities is actually that a large part of it is being held by retail investors, and these are, in my views, really easy to influence by the mass media, where they actually contribute to more than 80% of the total market trading. Of course, the views of the retail investors around this topic has a huge implications of the demand and therefore the valuation and the share prices. Now, I found an article out there published in Nikkei Asia, which really reflects the way that I am thinking about this whole situation. And the author is William Bratton, who previously was the head of equity research by Asia Pacific and HSBC. I will link the article in the comments so you can read it yourself. But here are some of the most important takes in my views. So first off, I like his historic views about, like, in the 90s, it was in vogue to criticize Chinese reforms, that they would fail due to entrenched vested interests. In the 2000s, there was a theory that the low-cost export-oriented model is unsustainable. And in the 2010s, lots of critique around the China's debt-fueled growth economy, which now I would say is resulting in the next topic, which is this debt bubble is going to burst and causes huge harm in China based on the crackdowns by the government kind of popping this bubble, and therefore the domino effect is kicked off and everything is going to collapse. Now, the first point that he is making is that despite all these historic fears around China, China has always powered ahead, meaning that it was always kind of misunderstood in a way this would possibly play out in the future. He mentioned Gordon Chang as well as the economist Paul Krugman, which all have been wrong about their takes in the past, but also more recently. And his broader take here is kind of that the West is projecting an image into China, comparing it to the Soviet Union and how the Soviet Union has collapsed, and also, you know, playing with all of these communist as well as the authoritarian governance structure themes, which in their views and interpretations are very inflexible and are leading to this economic bust. And then the author is doing something similar to what I've been outlining before as well, and calling out double standards, basically saying that it's interesting how we in the West are actually having similar motives and trends right now, mainly regarding social issues like inequality. In China, there is, of course, the term of this common prosperity, and it's a big government theme, right? But nowadays, and we just had this tweet by Elon Musk around that he's going to sell 10% of his stakes in Tesla, just because there is so much pressure by society and the government implementing taxation on unrealized capital gains in order to make the society not fall apart. So whereas we call out those things in China specifically and say that this is the source of all evil and why things are going to collapse, we are actually facing very similar issues in the West. And so he is calling this a false hope of a future in which China joins the USSR as a footnote in history, while actually the economic reality is that yes, there might be problems with the unwinding of leverage, for instance in the property sector, but the recent developments will unlikely change China's long-term economic trajectory, and the dominance of the Asia economic system will further grow with difficult consequences for the rest of the world. So while I think, yes, there are really issues in China that need to be called out, for example, turning an entire industry like educational sector into non-profit. But from an investor's point of view, it's so crucial to really not stick to some kind of ideological or even political themes in terms of what we like to project and like to see in China, how they are failing, or the examples that the author is mentioning here, but just to gather a more realistic view on what may actually really happen. And so therefore, I personally don't take those voices out there too serious that are super aligned with the common theme in the media that we're seeing there and paying into that. And of course, there are investors out there who have a more rational view or also are more connected on the ground, possibly having a team there, going to China more often. And I think that really helps to better understand and identify opportunities there.
The more you have contact, I think the more you understand it. I don't think it's well understood. For a long time, the question is, how can communism and capitalism coexist? That's the riddle you have to answer, and he had to answer it a while ago. And what do these people want at the top? And what the answer to that riddle was told also by Deng Xiaoping when he was asked. He said, it's glorious to be rich. And then they asked about capitalism, and he says, it doesn't matter if it's a black cat or a white cat, just as long as it catches mice. And so the idea is producing wealth. And so capitalism, yes, but the redistribution. Okay, so we have four things that are really going on in China, if you understand their intent. Common prosperity is the word now, okay? And there's been the objective to raise money and then to broaden the base of that. Okay, right. That's common prosperity. So if you look at their tax rates, they're lower than the United States. If you look at the measures of almost capitalism, they have as much capitalism or more capitalism, much more so than Europe, for example. And now they're in a prospect to broaden that. So I think there's a tendency, and an understandable tendency, to think because they are Maoist and communist, that they're going to go back to that kind of a thing. And they're not. Deng Xiaoping, Xi Jinping, just, for example, introduced the newest stock market in Beijing. He made a point of being the one who introduced the market in Beijing to the small and medium-sized enterprises. They know that it catches mice.
And I can honestly say, by living in China, making business in China, that this pragmatism and the interest to make money really is a very strong topic in China, and therefore this strongly resonates with my personal views and experience of how I perceive China, which is enormously in contrast to what is perceived China to be like in the media. Now, of course, the big question is, how long can the sentiment stay depressed or the valuations down, because the rationale is not there for the underlying fundamentals of where China and its companies are going. And I would say it's only a matter of time until the sentiment will shift again. Investors try to allocate capital as efficiently as it's possible.
People tend to make that huge mistake of going into the asset that's done the best looking backward. If you look at the situation today, the US is priced for perfection, right? There's a lot of challenges. Any way you look at the challenges in the US, you've got this essentially economy with strong inflation pressures, requiring a lot of fiscal policy, very low interest rates, paper wealth at extremely high levels relative to incomes. Lots of challenges. On top of that, of course, everybody's living the political conflict and the risks associated with that. And yet everybody's pouring in. to US assets, based largely on the thing you're saying is for the last decade, that was by far the best thing. But if you look decade by decade, it's almost always true, like just super simple strategy of go short the equity markets that were that did the best in the last decade and long the ones that did the worst. That works by itself. I mean, I wouldn't recommend that as it's overly simplified. But the reality is the expectations for US and US technology are so extreme relative to the rest of the world that not only does the US have to massively outperform economically, it's got to outperform faster than it did over the last 10 years in order to outperform on a financial basis. So that's a huge deal. And it is different. The pricing is certainly radically different than it was 10 years ago. And the range of outcomes, who knows, maybe the US just dominates everything and you go from 60% of assets in US assets to 80%. But more likely, you go from 60% to something more in line with the US's relevance in the world.
Okay, we got that message. This time is different, says Greg Jensen. Look, if we go to one of those outside opportunities, China is a country, a market that Bridgewater's been very enthusiastic about in the past for many good reasons. We've had a pretty negative news flow out of China in the last few months, and a lot of questions even about the investability of China. How are you seeing that? And what would it look like, do you think, for China to become uninvestable?
Yeah, well, a few things. I mean, everybody looks at the equity market, right? This is across all,
which has performed horribly.
All investors, right? But that's not really our perspective. We look at a balanced mix of assets and what can you do in China, right? So a balanced mix of assets in China, if you include China equities, China bonds, commodities, et cetera, is up steadily this year. So up this year. So yes, stocks are down because policymakers have made decisions balancing several goals that they have. They have goals for common prosperity. They have goals to make sure that information security and that no company becomes more important than the party. They have goals also of becoming a world superpower for which they recognize they need to be an investable financial center. And they're going to be. They've been moving in that direction over the last 25 years, step by step. Every once in a while, whether it's 2015 or whatever, they take a step backwards to achieve some other goal related to stability. And you're seeing one of those. But I would not extrapolate that to mean they're moving away from building financial markets that compete globally, that attract capital, because they recognize that every superpower has always had them. Their plan is to be a superpower, and they're moving consistently in that direction. So we do think it's investable. The health of those markets can somewhat be shown by the fact that the balance between assets has worked as it always does as it has normally in other countries, and in fact is more reliable today in China than in the US and Europe because interest rates are at a more normal level. So when stocks do go down, bonds rally in a more predictable way than, let's say, in the United States today. So those are the issues, right? But unquestionably, there's regulatory risk in China. They don't have the rule by law setup that we have in the West. They're coming up with the laws today and sort of doing what we'll call rule of law, but they don't have a structure for how to deal with these companies, the profitability of these companies. That's all happening on the fly. And that's messy and certainly create nerve-wracking situations for investors. But if you look at that, a lot of that is priced in. I mean, the same asset in China relative to the US is probably at a 40-45% discount in terms of if you're looking at reasonably similarly expected cash flows. So maybe that should be worse. Maybe that should be better. Our basic point would be you're still better off having a diversified mix of Chinese assets with US assets. And that's been the case, again, recently, even in this year, if it's not an all equity-based investment.
And of course, in a world where the US markets are priced to perfection, I think at some point the rationale will kick in and there will be money coming back to China and create more demand and thereby also lift possibly all of the boats. And then by this time, of course, the smart investor would like to already be invested in some of the best names out there that are fitting the hunger for investors. And so while it is the most fierce and hard times to invest now, with all of the negative news, with all the uncertainties and all of the fear around it. I personally think it could be one of the best macro trades out there currently in order to position for this change that is about to come. In my point of view, I don't know if it will be in weeks, in months, or even in years, but I do think it will be the case, and that's why personally I put my money where my mouth is, and I have allocated more of my share of the portfolio towards such investments. We'll see how it ultimately plays out. I will keep you updated. For my patrons, I'll even make the portfolio walkthroughs, but of course here on the channel I will keep comparing myself even to the best in the industry like Kathy would, and see how my portfolio can perform over time with this big China call here. So I hope you enjoyed this. Let me know down in the comments what you think about Chinese equities. Are they investable right now? And then thank you guys for watching, and see you in the next one.